All right, hello traders. This is James Stanley with StoneX and FOREX.com, covering the opening bell for Mr. Michael Boutros this morning, and it's CPI day. Data dropped just an hour ago, right in line, 3.4% headline, 2.5% core, but there's some items under the surface that I think are of interest, and we have a PPI report tomorrow that could still have some sway on the inflation matter. First, you need to look at a risk disclaimer. Please review this. Pause the video, take more time to review this if you so need. There are a number of charts that I'm going to look at in this session. Going to start with USD and circle around that topic. But hello, Acacia. Good to see you in the room. But let's go ahead and get to it. So again, first and foremost, on the CPI print, it came out right in line. The expectation was 3.4% on headline, which you see right here graphically depicted. Slight reduction from last month, but it still held the trend from that peak of 4.2%, 4.2% on the release in June, 3.5 last month, and 3.4 for this month. Hello, Chandrasekhar. And, so that's a positive underpinning. We could see this impacting rate expectations already, where there's now a higher probability for no hike in September. This edged up a little bit. It was like 50-50. It was basically a coin flip yesterday. And you can see it was only like 30% a month ago. So we've seen quite a reduction in that expectation for a rate hike in September. Going out to the end of the year also softened a bit, but not all that much. It's still 28.8% for no moves into the end of the year, which deductively leaves us like 71.2% probability of at least one hike into the end of 2026. So that hasn't whittled down all that much. That said, the PPI report tomorrow could possibly be more important than usual. Now, PPI is an input, or it's often thought of as a lead-in for CPI, because if producers are paying higher prices, then often they're going to pass them on to the end consumer. So normally there's a relationship in there. And you can see the expectation for tomorrow is for a sizable reduction from a 4.7% print down to a 4.2%. Now, the reason that I think this could matter more than usual now is because of what we're looking at between that difference in core and headline CPI. Right now, the big problem was the flare on oil prices that we had earlier in the year, and then how that might flow through into other products. Now, core, of course, strips out food and energy, so it mutes that to a degree. But the big concern, based off of the flare that we had in headline CPI in that print in June, was that it was starting to filter in to not just food and energy prices. Because you can see we also had a quick bump in core as core went up to 2.9% that month. It was at 2.5% back in March. Let's just go ahead and get that filled in. Go. Now it's complete. We had 2.5% in March all the way up to 2.9%. So there was the fear, the worry that while core stripping out food and energy wasn't going as quickly as headline, that it was still passing through to the end consumer into products that weren't directly energy or food related. As a case in point, I always use the story of widgets, but you could take anything. You could take cell phones, you could take consumer electronic products, magazines, whatever. The cost to ship that to the in-state consumer is going to increase if transportation costs increase. And so naturally, there's a relationship in there. It's not lockstep, but often you'll see companies raise prices based on the fact that it's costing them more to get their product to the end consumer due to those higher transportation costs. And that's where we'll see that difference in core and headline. There's usually a delay. Now, again, this puts perhaps even more focus on producer prices, because this is something that is going to impact the producer, the maker of the magazine or the cell phone or whatever. If they're paying those higher prices, that too will filter down to the in-state consumer. So this is going to be a really big print for tomorrow, perhaps more so than it usually is. But, like we're seeing today, more important than the actual data print is the delta from the expectation. If this comes down to a 4 handle, then we're going to see those inflation expectations recede. We're going to see rate hike expectations drop pretty dramatically. And that's something that I think could have a repercussion across FX markets, USD, dollar, yen, etc. So there's a lot that could happen off of that one. And then to end the week, we get retail sales and U of M sentiment. So a couple of high impact prints out of the US that I think could still matter quite a bit. Perhaps more interesting is what happened earlier this morning leading into the CPI print, you'll notice right here, and again, it was right around the European Open. Dollar yen got hit pretty aggressively, and it looked as though some people on social media were trying to make the accusation that there was an intervention effort. And you always got to be careful with those, because these interventions, they're we're not going to have confirmation until it's already too late. Which is why I think there's high speculation when we get a dip of this nature. But it's kind of like I was looking at yesterday, where on pullbacks, this is still a somewhat attractive long setup. The problem is there's theoretically capped upside. As we get closer to that 160 handle, there's kind of the fear on the long side of whether you're trying to pick up pennies in front of the steamroller. We get that dip down to support, maybe not as unattractive again. As a case in point, these are rollover rates. Now, granted, and this is just what's on the webpage for today. These rates do change. It is Wednesday, so it's triple witch. Standard disclaimer applies. You could read it down here, where rollover rates are displayed based on a 10K position, estimated based on previous roll and number of days being rolled. So for today, it's triple witch because of the weekend and settlement transaction. Case in point, for example, typically Wednesdays are rolled for 3 days to account for the weekend. These do change, so just keep that in mind. But on the long side of dollar yen right now is showing at 132. On the short side, 333. So if holding this past rollover this afternoon, there's a credit on the long side, a debit on the short side, and that's on a 10K position. So that's sizable and higher than usual because of the triple roll. But you could see where we had this quick shock, this quick dip. And when I see that, my initial inkling is not necessarily that it's intervention, but that somebody with size dumped a position. And they did it quickly. They wanted to get out for fear of what this US CPI print might have been. Because if this came in at like a 3.2 or a 3.1 on headline, showing that CPI was coming down even faster than expected, these rate hike odds could completely price out. And then there was less reason to be holding on to hedges for that dollar yen long carry. But the fact that it dipped down and quickly found support, quickly found a bounce. I mean, you could look at this on even on a 1 minute chart. That to me says that it was a big order that was just quickly filled into the market, right? Especially given that long underside wick, and that there was some element of defense right at that 38.2 Fibber retracement that so far has held this up. So at this point, the fundamental bias, I mean, I think obvious still has a long side type of influence here. As a case in point, given the bounce that we've seen off support of prior resistance so far. But as we get closer to some of these resistance thresholds, it becomes more of a challenging prospect, because there is theoretically capped upside, given that we had both the BOJ and the Treasury Department stand in on the matter. Oh, Latanya. 164 is, I think, that what I'm considering. 164, 165 is what I'm considering that absolute line in the sand. But I think 160 is even a daunting prospect. If we get above that, it almost feels like you can hear the train coming down the tracks, and you're just kind of playing with fire. But markets are going to sniff out weakness, and that's something that has been a common thread in dollar yen going back over the last 5 years. Initially BOJ tried to stand at 145, got a pullback. And you could see the way the bulls treated that. It was like slowly but surely they tested that resolve. We get above those highs, those stops get run, and it goes right up to the next big figure. And then, kind of the same thing. BOJ intervenes again. It gets bulls on their back foot. It doesn't get the reversal. It just gets them on their back foot. It scares bulls off the long as we get closer to that 150 retest, which is why we got the lower highs. But what ultimately compelled the reversal was a below expected US CPI print. That's not what happened today. CPI came in right in line. There's not that overriding fear that inflation is cratering and that the Fed is going to eliminate these rate cuts. I think if anything, the next major Fed driver is Kevin Warsh at the Jackson Hole Economic Symposium. I'm expecting him to play the role of hawk again, and I'll talk about that here in a moment. But same thing here. This was a below expected US CPI print right in here, November 14th, 2023. Right, we had towed right up to 150, 195. Again, bulls are testing that resolve. if there's pennies on the train track and they think they could get off before getting squished, they're going to go after them. And um, that retracement was just 23.6%. And then, sometimes you get on that track and the train doesn't come. And that's what led to the breakout. Another intervention, pullback, bulls go right back into it. And then, you can even see on the next test of 160 where they're kind of playing with fire, but that was a below expected US CPI print. Again, did not happen today. But given the jumpiness that we've seen in this short term, I think if that PPI print comes out tomorrow in a really disappointing manner, I don't want to say disappointing, that's subjective, but if it comes out really below expectation, like if we get this at sub 4, it's going to look like the inflation fear is overblown, and then there's perhaps even more reason to price out some of those rate hikes from the Fed, and then more reason for longs to bail, which could lead to some bearish momentum in the pair. But for now, it's holding structure, support at prior resistance. The next support zone down, it's a pick 'em. 157.78 to 158.09 is the one that I've been tracking, but this 23.6 is where we had the pivot around NFP last week. And kind of similar, where you could see there was a bit of a shakeout here. That was not an intervention move. This was right on the morning of US NFP. Disappointing print, but not an intervention move. And this is longs bailing. Longs using that bounce, longer term longs using that bounce to bail out of positions. And then, other more adventurous buyers come in to buy the dip. And that's kind of what's been happening so far this morning. This zone, the reason I've been tracking it, it's a big one. It was resistance over a couple of different occasions last year. It came in as support. It came in again as important after we had the bounce building. Notice it was resistance that got chewed through until that NFP print. So if we get down there, that's another area where a possible bounce could play in dollar yen. USD, I still think it's a as goes dollar yen, so goes the dollar basket. But in interest of not being just completely one-sided, I want to look at a couple of scenarios that could possibly play here. In the dollar, it's been churning at this support. It's been grasping onto a trend line, not a great trend line, but it's been grasping onto this trend line. So there's a couple of different ways to look at this. One, the fact that support has held, that is a positive if you're looking on the long side. But the other side of that is each of these bounces so far have been faded pretty quick, pretty hard. And the fact that it hasn't put in greater recovery after that sell-off from 2 weeks ago, I think is something that longs need to look at and consider before taking on topside exposure. So, when I see something like this, I want to start thinking contrarian. I want to start thinking of, okay, well, that support's held so far, but what is it ultimately that could get this lower? And of course, that dollar yen factor is a big item, but that PPI print, again, it comes in as something that could possibly be important on this whole trend. If it comes out significantly below expectation, and I'm saying significantly below, I mean like I'm considering anything at a 4 handle or below as significantly below expectation, then I think that's reason for these rate hike odds to price out a bit more, and then more motivation to bail on USD longs. But that Kevin Warsh appearance at Jackson Hole, I think it's going to be a pretty big deal because so far he's been surprisingly hawkish. The June FOMC rate decision right here, notice that we were at the same spot when we went into that meeting as we're at right now, right? So we've kind of round tripped Kevin Warsh's experience at the Fed so far. But what came off there was the fact that Warsh did not meet the expectation for how dovish markets were expecting. Trump went around and around on this matter ahead of his nomination, and he even went so far as to say that a willingness to cut rates was a litmus test for whomever he was going to choose. And Warsh gets in, and then all of a sudden he's talking about how inflation's never really been tamed, how the Fed never really got the job done, how that's their priority number one to make prices more affordable for the average American citizen. And that, I think, shocked a lot of people. But, I think if you look at the matter big picture, it seems as though Warsh had no choice, because he went in with those expectations that he was going to be so ultra dovish that he was just going to cut rates regardless of what the situation needed. And as a case in point, look at the way that Treasury yields responded. We got that initial hawkish meeting, June 17th, right here. The 30 goes down and makes a bottom. but then it goes right back up. And so this is, I think, what Kevin Warsh's main concern and main problem is, because if markets expect that Warsh is going to cut rates even with inflation being high, then they're going to treat that by selling treasuries. Because who's going to want to hold 30-year paper at 5.2% if inflation is expected to go up to 3% or 3.5% or 4%? If the Fed is going to accept a higher inflation target or a higher inflation threshold, that just eats away at these long-term returns. You know, and as a case in point, you can look at what happened back in 2024. I think this is a very informative event. This is when the Fed was cutting rates, even with inflation being too high, as right ahead of the election, right? You could see we bottomed right at that rate cut, like 3.9% on 30s. And over the next few months, we rallied all the way up to a 5 handle. This is markets selling treasuries because they're saying, well, if inflation is going to go higher, why am I going to hold 30-year paper at 4.2, 4.3, 4.5, even 5%? There's no reason to. Meanwhile, the Fed's trying to juice the economy with low rates. So why don't I just buy stocks instead of holding my money in treasuries that are A, losing money because rates are going up, but B, they're bringing me a substandard rate of return. And so it led to an exodus. And I think that's the big problem. That's the big concern. And you can even see right now on 30s, there is a very big fear that there is a massive breakout that could happen thereafter. And this is one of the reasons why the U.S. has been so active on the Japanese yen intervention front, because Japan holds $1 trillion in treasuries. If Japan needs to finance an intervention, probably going to sell some treasuries. They're going to sell treasuries. You're going to see this thing go up again. As case in point, Fed week, this set a fresh 19-year high right after Kevin Warsh's press conference. We're still hovering around there. It's kind of in a tenuous state right now, but the long-term trend, it's not positive. So if you're Warsh, I think you have to retain that hawkish lean in front of the press. But I think the reality is he does not want to hike rates, because he hikes rates, Donald Trump is going to eviscerate him on social media. He said he's not going to comment on Warsh, and he's had some decent comments on the matter, saying that it's not all up to Warsh. It's a board decision, which is all true. But for the crowd that Trump is often speaking to, I don't know that they understand that nuance or care about that nuance. It's, you nominated this guy, now he's hiking rates, mortgages are more expensive, everything's more expensive. Who's the scapegoat, right? Just like, too late Jerome Powell, who got eviscerated even though he was cutting rates. Okay, bringing this back to other matters. So in a market like Eurodollar, the whole reason I went on this 18-minute spiel is because I think that this is all derivative of larger macro matters at the moment. And I think if you look at price action, that kind of proves that, because ever since we had the Fed fueled breakout, the Japanese yen intervention breakout, it's basically been back and forth piano keys in Eurodollar. And we're kind of in this midpoint stall area, which isn't necessarily bad. If you trade mean reversion, if you trade ranges, it's not terrible, because you can see these underside wicks on the 4-hour. You can get pretty good a clue that buyers are coming in at support for prior resistance. And at the very least, this could offer some asymmetry in setups, relatively tight stops that could be offset with wider targets if just looking for a revisit to resistance. So at this point, mirror image USD, where I have USD in that kind of that bearish pattern that could possibly break down. I think this would need some help on some dollar yen carry unwind, but same story. Bears have had an open door to go for a breakdown, to go for a retest of 115. They've just seemingly failed to do so. And at this point, I'm looking at this resistance zone as being vulnerable in Eurodollar. It's 1576 to 1613. It's a big spot. Above that, it's like 1670 up to around 1686 as my R2. And then R3, it's this zone up here. It's a long-term zone. It's the 764, 786 X bands from this Fibber retracement. Oh, excuse me. This Fibber retracement, the 2018 high down to the 2022 low, which has had a lot of action. It caught these highs, but that's right around 118.43 up to like right around 119. That's what I'm looking at as an R3 in a breakout scenario. But again, for that to really take hold, I think we're going to need to see the dollar yen pair break down a bit. For some dollar strength, at this point, it's bulls to lose. This is the S1 zone. So far, it's been pretty well defended. It's right at that 115 handle, the 115.16, and then right down in here, notice prior resistance on a couple of different doses. 114.55, 114.69. That's what I'm looking at as my S2. The one that I like a bit more for USD weakness at the moment is cable. And, I've been tracking this one in these sessions. where there's been some clean techs. It's a little more daunting now that we're above that 135 handle, but looked at this Monday, looked at this Tuesday. On Monday, it was just testing that 135 break. Got the 135 break yesterday. It held support at that 135 break. Now it's just filtering up again for a fresh near-term high. So, the techs are there to justify this on the short side of the USD. And I think this is something that could be extrapolated elsewhere. So, like if you are looking for yen weakness, but you don't necessarily want to fight it out in dollar yen, maybe there's something in pound yen, to strip the dollar out of both that, something in pound yen that could possibly be worked with. And I have this at a pretty big level as well. Let's go to that one. Right in here, right at that 215 handle. So tough area to chase. I think about the best we could do on something like this is try to demarcate some areas to look for pullbacks to play and then wait and see if the setup fills. But, you could see it's grasping to that 215 right now. But a possible way to avoid some of the mess that's in dollar yen is still looking for that yen weakness to play. But cable still, I think, one of the more attractive short side USD setups, and that's evidenced by the fact that we do have fresh highs coming in right now. Also, I think some comparative analysis can always help when matching across majors. When we had that falling wedge into FOMC and Eurodollar, we similarly had one in cable. The one in cable was, to my eyes, a bit more aggressive, and we could just AB it. Because if you think about it, the dollar side of this pair is the same in both, right? So what are we comparing when we look at that deeper angular pitch in cable versus euro? We're seeing the differential in GBP versus euro because we can rule out the denominators. And you look at that falling wedge that was in cable, it was a bit more aggressive, broke out a bit harder, and even to this point, which helps to explain why I have this preference right now. We have fresh higher highs in cable after a series of higher lows that simply have not yet been able to play in euro dollar. So I think both can be justified on short side USD, but it's that cable setup that speaks a little bit more loudly, given that we are at fresh highs right now, given that it has extended, that it has shown some run above the 135 handle that euro dollar just has not been able to keep up with. Aussie dollar. So we had the RBA rate decision a little earlier this week. As I said then, I thought the bigger deal here was going to be this morning, and so far that's proven to be correct. RBA right in here, Monday. Well, technically, I think Tuesday is when that played. And we had a quick dip below this Fibonacci level, but buyers came right back in and they pushed it up to a fresh high with an assist from some of this dollar weakness that's played through so far this morning. I got it at a really big zone right now. So as a rule, I'm not huge on reversals. I will work off them. It's a much different type of trade management though, because essentially you're going against the grain. You're saying the status quo was wrong, and I think that's kind of a dangerous area to be. But given the way that you can situate around reversals, I think there's a possible mechanism with which you can follow them or trade for them or look for them. But just on a long enough time horizon, if you're going with the status quo or the trend, or you're going against the status quo counter trend, you have to equate a lower probability, at least I do, a lower probability of being right when going against the grain. You're expecting change, right? And I think most of the time the status quo holds to a degree, unless there's a reason for it not to. But trading isn't just about winning percentage. It's not just about being right. It's not just about guessing right. It's not just about guessing trend correctly. It's about, at the end of the day, making money. And so if it's a reversal setup and I can get a 1-to-4 risk reward ratio, then technically I need that to hit 22 to 25% of the time to build a profitable model over the long term, right? Because if you think about it, you take the setup 5 times, you're wrong 4, you're right 1. If that 1 time is 5 times is right, then it can offset those 4 wrongs with a little bit of margin. You also got to equate for spreads. You got to equate for slippage. It's not going to be a perfect model because you're not going to get, a perfect entry and exit every time. And then stop and limit logic kind of can work against you. So, you don't want to build that as like a rigid mathematical equation. But, if you can offset those multiple times being wrong with 1 time being really right, then it could possibly work. So I got this in resistance right now. Again, it's something that I'm still tracking as an uptrend. So it's not necessarily something I want to fade right now. But the way that I could work off of this is if I do get this 4-hour candle holding at that resistance, if it could show a doji, even a spinning top, there's the possibility of reversal in there. Now at that point, that's I think the highest risk moment to try to take it, because we just made a fresh high and there's no evidence that it's going to come off yet. But it also would have the opportunity for slightest risk outlay, because if this pops up to a fresh high, then the thesis that it topped is wrong. Alternatively, if I wait for some confirmation, now that stop is going to be wider because there's more distance to the high. But there's also, again, at least in my mind, going to be a seemingly higher probability of a top being in place because there's been follow through from shorts, taking their shot at that resistance. So we're at a big spot, and this possibly could be justified for a reversal setup. But with that said, it's a bullish trend, and there's no evidence that it's over yet. So I think again, at least in my approach, the cleaner way to handle is to look for a pullback, evidence of support, bullish continuation until there is a greater show from bears that this thing may have actually topped and maybe done for. But again, like we looked at Monday, Tuesday, clean trend so far that has pretty much held for the entirety of Q3, and it's just churning higher. That's Aussie. Last dollar pair on my radar for now, and then I want to take a quick look at gold. But last dollar pair on my radar for now is dollar CAD. I have this beaten right into support at the moment. So I went over that whole reversal spiel for a reason, because I have this one in a pretty big spot, and sellers haven't exactly taken advantage of the opportunity yet. So this is one that I'm going to be following into the close, depending on how it operates. But 139 previously a big spot. I went over this on Monday. These psychological levels in a pair like dollar CAD, these natural crosses, they could be really big, and you could see where 140 was really big. We had some hold up and a bounce. We finally got below it, and then we broke below it with aggression last Friday. But since we broke below it, there hasn't really been much position squaring from shorts. There hasn't been much give back. We've simply just seen a degree of stall around 139 that is showing tendency of giving away right now. So, again, the reversal's not there yet. But if this closes above 139 today, that's going to look like an underside wick. And the whole reason that I'm interested in this is the prospect of capitulation. Capitulation as in sellers had an open door to go for the break, and they failed to do so. I think there's a good example of that right down in here. You can see where sellers were firmly in control of the trend. We poked below, we got this underside wick, and then it sets a hammer. A hammer formation right there, that's a pretty beautiful candlestick, single candlestick when it does show, because it illustrates a possible change. Now, again, you're not going to perfectly predict the future with the past, but this offers the potential for asymmetry, because where it's wrong if the setup doesn't play. If we take out that low, then the thesis that it's bottomed is incorrect. There's no reason to stick around to see how wrong you might have been. But it could also be shifting or indicating a change in the guard, a shifting, if you will. Now, we don't have that right now. All we have is a test below a big level. But if we hold above 139, then that's something that could possibly begin to open the door on the short side of the pair. At the very least, I'd be cautious to chasing this just because of how strong the CAD has been of recent. And it would just be a really tough trade to manage, in my humble opinion. So if looking to get short, I'd at least want to pull back with a retest at 140 before I'd be able to do anything there. Or maybe even more ideally, you could try to get, a little bit cuter with a swing level. Like there was this swing high that synced into this swing high, and then the swing low. It's like 139.67. So like let's say we did get a bounce. Ideally bears would be so aggressive they wouldn't even allow for a 140 retest to come in and swat it down, somewhere like that. But chasing this one, I think, is pretty difficult, especially since we're nearing oversold territory on the daily. We are oversold, not quite oversold, but we're diverging with RSI on the 4-hour. It's been a chunky move of late. Daniel Leslie, CAD yen, another interesting option given recent CAD strength. Yeah. That's, I think, one of the benefits of the FX market that a lot of traders might not give it credit for is the paired nature of it could be advantageous from that perspective, where you could take those prevailing trends and essentially operate off of them. You know, like if I wanted yen weakness, I don't have to marry that up with the USD. That said, I think there could be carryover because, you know, when you look at where a lot of the size in these markets operate, it's usually in the major. You know, you don't get a lot of banks that are doing you know, significant business in a synthetic cross. But, you know, as a retail trader, that's possible opportunity. Um, but that would be a way of stripping out some of that USD risk if looking for yen weakness to run. And, you know, essentially the trade then becomes, um, you know, you're anticipating that CAD strength against the dollar is going to continue. So there are ways of working around that for sure. What I usually do with the yen is I usually keep it to euro yen pound yen, and I look for those derivations, kind of like I looked at with euro dollar pound dollar, where pound dollar looks, um, you know, a little bit brighter than euro dollar. Because it's real simple for me to just A/B it, where like the dollar is the same in both cable and euro, and the fact that euro is looking a little less bullish than cable. Okay, well I want to simply divert long plays against the dollar into sterling. Daniel says, yeah, the spreads are tougher. Yeah, you know, that's one of the dynamics because, you know, with these majors, that's often what a lot of um, what institutional markets are working off of. And so to cross it increases the spread. Less liquidity in those markets as well. That also impacts spread for sure. Okay, and last but certainly not least, gold. Want to look at this because I think there is, you know, I went over it a couple times this week. Gold is something I follow pretty closely because it's almost like an anti-currency, but you know, the way that this worked off of that 4K level was beautiful. It was, you know, a month and change of support, finally broke out last week. And so far that breakout has continued. And so far the response we've seen to the CPI this morning, that's continued. You know, I think the compelling part about gold is that I think it has an incredible way of trying to look around what's at that next corner. And, you know, the fact that we are seeing bulls make another run for it, I think, you know, especially given the way that this priced in, you know, because we had this explosive move um, that came into this year. I mean, you can even look at these prior moves, right? It started a rally back in 2024 when the Fed sounded like they were going to cut even with inflation being high. You know, so it has some overlay in that yields conversation as well. Runs all the way until the election. Bitcoin starts to take over at that point. Trump gets in, he starts talking up rate cuts even with inflation high. Powell doesn't sound so certain, and so for about 4 months this stalls at 3,500 all the way until Jackson Hole. Jackson Hole again, you know, it's coming up. It's I think the next big wash deal. But Jackson Hole is ultimately when gold got back in the driver's seat. Gold bulls got back in the driver's seat August 22nd last year. This is when Powell finally sounded ready to begin cutting rates. Gold, another explosive move. Another explosive move. And, you know, it's one of those moves that got so far ahead of itself, you know, kind of like dollar yen, where you got that long carry in 22, 23, 24, where so much of the market is one sided that even a hint or whiff of change is enough to compel a drastic reversal, and that's precisely what showed up here. But, you know, that said, once we got down to 4K, which did, mind you, have an assist from that FOMC rate decision on June 17th, you know, Warsh sounds more hawkish than anyone's expecting. Gold finally dips down for 4K, but it doesn't break it, can't hold it below. And then ultimately begins to reverse as both inflation softens and the Fed doesn't sound as though they're too certain on this hawkish thing. You know, so I think that this is gold trying to look around that next corner, expecting that the Fed is not going to hike this year. You know, inflation could shock that. It could surprise it, especially given the sensitivity to oil prices and dependency on SPR for keeping supplies and oil high. So there's a lot of factors that are there, of course, but I think this is, you know, again, gold bulls looking around that next corner. That said, the pullbacks so far have been very mild, very light. The support looked at yesterday so far has held 43.58, and we're right back up at those fresh highs. So, you know, chasing this higher at this point, not simple, but we are trading through a really big zone. This 43.80 to 44, let's call it 44.25 zone, was a big one of resistance turn support. You know, it's working above it now. So a couple of different ways to work off of this is either A, let the breakout hit and then look for the pullback, the retest of that support zone of prior resistance. I know patience is not the way that a lot of people want to treat these moves, but chasing an already built breakout, it's just a dangerous way of trying to manage risk. But secondarily is if we do get some posturing at these highs. I mean, you can see there's already been a degree of that, but if we do get some posturing at these highs, maybe a bit of profit taking, um, that could be support. You know, it's already had a couple of bounces, but I think more realistically, like a 43.05 or something becomes a bit more attractive. You know, I think where gold gets exciting is when you get people saying, okay, the breakout failed, it's false. You know, but that's generally only a read that's going to be had off of like these short-term intraday charts. But big picture, the move has been powerful so far. So that's heavy on my radar as we go into the end of the week. That, my friends, what I have for today. Tomorrow it will be Razan, and I will be back on Friday. So I will speak to you, ladies and gentlemen, on Friday morning. As always, thank you for your time. I hope you have a great rest of the day, and as always, happy trading.